welcome to the July installment of our Market and Strategy Update. My name is Jim Scanlon. I'm Managing Director here at the firm. And I'm joined today, as we are each month, by Head of Research and Co-Portfolio Manager Jim Warner. I would like to thank all of you for taking the time to join us today. We certainly appreciate and value your time very much. And we're also grateful for the trust that you've placed in us in allowing us to manage the irreplaceable wealth of your clients. And that's something that we never lose sight of. As a general reminder, we encourage everyone to ask questions, please. We really look forward to that. There's a Q&A box at the bottom of the screen. Please, no need to wait till the end of the presentation. We'll go ahead and take your questions. So please, we encourage that. Many of you on this webinar today have been following our commentary over the last year, and you've heard us say numerous times that we are in a period of transition. In fact, it was the title of our year-end letter some 7 months ago. A 500 basis point move in rates last year was certainly a significant transition, of course. And as inflation continues to recede closer to the Fed target rate of 2%, the transition theme continues this year as well. And of course, the markets continue to amaze or scare, or you can use a bunch of different adjectives there. The S&P continuing its torrid pace, while the bond index barely just up about 1% this year, all of which continues to be a difficult environment to navigate. And we know investors remain and are confused. Fortunately, we think we have one of the very best in the business to help our clients navigate and make sense of it all. And with that, I'll turn it over to Jim Warner. Jim?
Great. Let me share my screen here, as I normally do. All right. Perfect. So thanks, Jim, and thanks to all of you for joining us on this lovely day for today's monthly strategy update. So the title of today's webinar is the stock market is a market of stocks, which is meant in a tongue-in-cheek way to remind us that the stock market is comprised of lots of individual stocks with unique opportunities and subject to different earnings drivers. Often we focus just on the market headline and fail to see what's really driving it. So we'll discuss that more in detail in a bit. I thought I'd start off by taking a step back to review our investment process. Our process rests on two primary pillars: our proprietary macroeconomic analysis, from which we produce not just this presentation and the research notes we publish, but it establishes how much risk to take in our portfolios, and also how we can potentially benefit from prevailing economic trends. And as you know, we tactically adjust the risk in the portfolio deliberately, depending on where we are in the market cycle. The other key pillar of our process is investing in powerful secular investment themes, such as the fourth industrial revolution or clean energy. Themes like these can offer sustained growth and profitability for affected industries and stocks that can even transcend economic cycles. I'm going to talk further about our macro views and a few of our investment themes during this presentation today. So let's start with our quick take on the macro. The markets are rallying because inflation is falling and economic data is coming in better than feared. The recession that seemingly everyone thinks is right around the corner still hasn't arrived. And so the S&P 500 has charged forward nearly 17% during the first half of the year. That's the 9th best semi-annual return in the last 30 years. As we have discussed, and we'll do so in a few slides, this performance belies the incredible dispersion in individual stock performance, which frankly is frustrating in the short term. The economy continues to be buoyed by a strong labor market, which does beg the question of how much further does the Fed need to tighten? And inflation is falling pretty dramatically and is nearly back to target. Finally, as we look out to the second half, we'd remind you that even though the market is trending up, pullbacks are commonplace. I have a great slide on this to show you at the very end. As of last Friday, the S&P was up about 16% for the year. The NASDAQ has increased a whopping 31%, and the Dow is up only 3%. This dispersion between the NASDAQ and the Dow's performance is highly unusual and is causing investors, including ourselves, a little bit of consternation. I've shown this data before, so I don't want to spend too much time on it. We'll distribute this presentation later, and so you can go into any of these slides in more detail on your own. But the extraordinary performance of the top 7 tech stocks, i.e. Apple, Microsoft, Alphabet, Amazon, NVIDIA, Tesla, and Meta, they're up 60+% for the year now, versus the remaining 493 stocks in the S&P 500 that are only up about 5%. So that paints a picture of very unique skewness. For the visual learners out there, I created composite indices for both groups. This chart is the ratio of the top 7 tech stocks versus the rest of the S&P. When the ratio declines, that means the top 7 stocks are declining relative to the rest of the market, and an increasing ratio would mean the opposite. As you can see, last year, the top 7 stocks underperformed by 36%. And then at the beginning of January this year, the tables turned, and we've seen these top 7 stocks outperform by over 60%. In doing so, they have completely retraced last year's underperformance. This sort of dramatic pivot in relative performance is very rare. And when you take into account that some of these tech stocks now have pretty stretched valuations, it's entirely likely that we'll see the tail end, we're at the tail end of this move, and we'll see the rest of the market catch up. Turning to economic data, and I'm going to run through these slides pretty quickly because the trends really haven't changed over the last month. We can see from the ISM surveys here that manufacturing continues to contract and the services sector is still growing at a nice clip. Remember, services growth is the linchpin of the fate of the economy. The labor market's still very strong, but June's payroll growth of just 209,000 did miss estimates, and the April and May payroll numbers were revised lower as well. We're clearly seeing a deceleration, albeit from record levels. And on the nominal wage side, nominal wages are growing at 4.4%, which is still stubbornly elevated versus a more normal pre-pandemic level of 3%. So this makes me think that the Fed has at least another 25 basis points to raise interest rates. And part of the reason for that is that they made a point of saying that they want to see wage growth decline. We have mentioned on previous webinars that we like to look at temporary job trends because they have served in the past to be a solid early warning signal for the broader labor market. The reason temp jobs are generally a good predictor is that temps tend to be the first to be hired as the economy improves, and the first to be fired when it weakens. For nearly a full year, we have seen temp jobs decline month after month. But as you can see in the bottom graph, there are still a lot of temp jobs out there relative to history. In our discussions with companies, the phrase belt tightening have become more prevalent across a number of different industries. And we've, of course, all heard about various layoffs here and there. And the question really is this just trimming excess staff or something more sinister? And we're not concerned about this just yet, but this is clearly a sign of a cooling job market. Even with the labor market softening a bit, it remains strong enough to propel strong consumer spending and even saving. And this is ultimately what is keeping the services sector growing at such a nice clip. Inflation keeps heading in the right direction. Our favorite measure of inflation that we've talked about in the past is from a company called Trueflation, which calculates inflation across 10 million different real-time data points in the economy. And they show inflation now running at 2.51%, which is getting real close to the Fed's target of 2%. This morning's CPI report showed inflation in June declined to 3%, 3.0, which is pretty remarkable. This beat expectations and therefore is very positive for risk assets. So you're seeing stocks and bonds rally pretty dramatically today. If you were to ask me what the biggest risk is to the economy, it would be the Fed raising interest rates too far. This data suggests that the Fed should be pretty close to being done. We still have to see how the economy digests higher rates because there is some lag effect, but a quarter point here or there should be digestible. So with inflation surrendering its place in our daily lexicon, Could it be that we now need to start thinking about the potential for deflation? And that's a word that we haven't talked about in years. This is where our minds go. I know that we're not there yet, but proper risk management means that we just start considering the possibility of deflation at some point in the future. So I updated this chart this morning to capture any moves in the Fed futures post the CPI report, and essentially there's no real change. The Fed futures implies that the Fed will likely tighten the overnight rate another 25 basis points at one of the next 3 meetings. I think more interestingly, and the other thing to point out on this slide, is that the market is now finally in line with the Fed's view that once they stop tightening, that they'll keep rates where they are for a while and assess the data. And so I think given today's inflation data, I think the market has it right. And for us, this means that the stock and bond markets are probably headed higher. So I'm just going to wrap up this section by simply saying that the economy is slowing slowly. The jury is out on whether services will succumb to recession, but there are definitely parts of the economy that appear to be in recession already. Just ask anyone in energy, banking, trucking, commercial real estate, you get the point. On the other hand, there are still plenty of sectors experiencing a lot of strength, including travel, entertainment, restaurants, healthcare, clean energy infrastructure, and let's not forget artificial intelligence. Given these pockets of strength, there are ample investment opportunities to pursue. All right, so let's talk about portfolio positioning. This is a visual representation of our flagship global vigilance strategy. For those who aren't familiar, this is a tactically managed strategy where we change the risk in the portfolio depending on how much risk we want to take. Our equity allocation across market cycles can range from all the way down to 40%, all the way up to 80%. And we have more aggressive and conservative portfolios that we also manage, but this one is generally most appropriate for private clients, which is why we show it here. This portfolio is being managed more conservatively than normal, and we've talked about that in the past. Although we have been gradually increasing the allocation to equities, which currently stands just north of 55%, kind of approaching 60, which means we have a bit more dry powder and fixed income than normal. Given the yield that we can get on cash and treasuries, that's not as bad as it used to be, but it is creating a little bit of a drag. Remember what I said earlier about how we develop investment themes. The yellow area represents various technology themes. The green is international. The top right blue box denotes our exposure to mortgage REITs, and I'm going to talk about that in a second. And we have a growing allocation to energy infrastructure. I'll call it that. In the next few slides, I'm going to walk you through some of these themes. We've gotten some really great responses back that people like to hear, how we're invested and how these themes develop. So I'm going to try to touch on a couple of them right now. So recently, we've also had several advisors and clients ask us if we have exposure to AI, to artificial intelligence. And in short, the answer is yes. AI is an important driver of what we call the fourth industrial revolution, which is a theme we've been invested in for a number of years now. We own, for example, Google and Microsoft, which are likely the biggest winners from AI adoption. We own QTech, the equal-weighted NASDAQ 100 ETF, which has 46% exposure to semiconductors like NVIDIA that you need to run AI. We own Path, the company's called UiPath, a company that designs software that uses AI to automate various business applications. And we also own a company called Datadog, which manages the data traffic at data centers where AI runs. And we have several other positions like Hitachi and Zoom and Expedia. They're all using AI to gain efficiencies and improve their product offerings. Some themes are more macro in nature, like our material investment and exposure to several mortgage REITs. We currently own, AGNC, Annaly, and REM, which is an ETF full of mortgage REITs. And combined, they generate a 13.5% dividend yield for the portfolio. As REITs, they must dividend out 90% of their taxable income, so they are an excellent source of income to the portfolio. So what is a mortgage REIT? A mortgage REIT is essentially an investment firm that buys government guaranteed mortgage-backed securities from basically Fannie Mae and Ginnie Mae. They use leverage to magnify the yield from these securities minus funding and hedging costs. We believe that mortgage REITs are experiencing one of the best investment environments they could imagine, which could mean a material appreciation in the value of their stocks. This environment is characterized by wide mortgage-backed security spreads that we believe will likely remain wide for the foreseeable future for two reasons. First, the Fed, which had been a persistent buyer of MBS at any price over the last decade while they were conducting quantitative easing, that are now gone. They've completely removed themselves from that market. Second, the supply of new MBS is really limited due to low numbers of home sales and virtually zero refinancings going on out there. What this ultimately means is that mortgage REITs can earn mid-teens economic returns on their portfolio, and this could even grow if they increase their leverage. Now, there are some risks, of course, the biggest one being interest rate volatility, but we believe that the Fed being close to being done tightening, that interest rates should show more stability, and they have over the course of the last couple months, thereby creating an optimal investment environment. Another name in our portfolio is First Cash, which is the largest pawn shop operator in North and Central America. We originally entered this position over a year ago on the thesis that with the federal stimulus money spent, demand for pawn loans would likely increase, and they did. Now, to be clear, pawn loans are not predatory loans. I get questions like this all the time. They're not, pawn loans are not predatory like, say, check cashing is. A pawn loan enables the unbanked or individuals with poor credit to access cash in times of need. So pawn loan demand is often driven by unexpected bills, like a medical bill that the borrower needs cash fast. So they put up their gold necklace or tablet or guitar as collateral, and they get a pawn loan. They get their collateral back when they repay the loan. And if they don't repay the loan, they just simply lose the collateral. It's not perfect, but it's simple and frankly humane because there is no cycle of debt created like some of those other products that you have heard about. But anyway, so during the last few months, we've seen a surge of Google searches for the phrase pawn shop near me. We wonder if that has something to do with student loan repayments restarting on September 1st, or maybe the Supreme Court's rejection of the Biden administration's student loan forgiveness plan. But whatever the reason, First Cash may benefit from this renewed interest. Finally, I want to preview a new theme, and I'll just call it for now electrification as a placeholder, that has evolved from our clean energy theme that we've been investing in for a number of years. And this is actually an interesting case study on how we develop themes and how they can evolve. We first played the clean energy theme by owning Cheniere Energy, which is the leading exporter of liquefied natural gas, and AMLP, which is an ETF that holds MLPs, basically midstream assets. And we did this because we recognized that a future with more renewable energy would still require natural gas for electricity generation because it's cleaner than coal, it's reliable and accessible. We also own the leading renewable energy utility, NextEra Energy Partners. Until a recent EPA ruling, which possibly ruined the future of renewable biodiesel, we had hoped that this zero emission fuel would be quickly adopted. This ruling showed essentially the administration's overwhelming preference for electric vehicle adoption. So we began to wonder if cars and other things are pushed towards electrification, how much electricity generation do we need? And how much does the grid need to grow? And typically, the electricity generation grows at about the same pace as GDP. But what if we add a lot more things that need to be charged? And can we get enough power where we need it, when we need it? So So we're gonna share more on this theme in the coming months. And you can also go, by the way, to the App Store and download our app, which is called LIM Technologies, which has all of our research. And we have a new piece out there on this topic, which I encourage you to read. But to begin to quantify the impact of EVs on the electric grid, we created a sample impact for a household with a Tesla Model S. Now, this analysis is loaded with assumptions that anyone could pick apart, but it is directionally useful. The average American drives almost 1,200 miles per month, according to the Department of Transportation. A Tesla S has a full charge range of 405 miles, which means it needs roughly 3 full charges per month. So using a 100 kilowatt battery means that nearly 300 kilowatt hours of electricity is used every month to charge the Tesla. Now, the average US household uses a little over 900 kilowatt hours of electricity each month. So adding a Tesla would increase that household's electricity demand each month by roughly 32%. This seems like a lot. While EVs compress less than 1% of vehicles on the road today, what about in 2030 or 2035? Is the grid ready for this? And what happens to the grid if most of these EVs are charged at the same time, say overnight when there's no solar feeding the grid? At this point, we have more questions than answers, but that's usually the start of an interesting secular investment theme. And as this theme evolves through further research, we will find a stock or two that we believe are the best ways to capitalize on this secular growth theme. All right, so I've just 3 slides left, bear with me, and then we'll do some Q&A. As for our second half outlook, given the huge AI-driven run in the top 7 tech stocks, we wouldn't be surprised to see the rest of the market do some catching up. Some tech stock valuations, as I mentioned earlier, have gotten a little stretched. And more importantly, there's a lot of attractive stocks out there. The non-tech stocks in our portfolio have terrific upside and also have low correlations to the S&P 500. So if the large cap stocks pull back and drag down the index, we think our stocks and our secular themes should hold up pretty well. From a portfolio positioning perspective, we are looking for dips to buy more equities. We would like to get that equity allocation up, but we want to be very calculated in the sorts of risks that we take. And what we are not doing is chasing this run up. Instead, we really like the idiosyncratic nature of our positions and believe that there's enormous opportunity for stock pickers like us. So I'll finish with this last slide. We analyzed the last 3 market cycles, and I mentioned earlier about pullbacks. We looked at the rallies that happened after the big pullbacks during the financial crisis, during the pandemic, and then in the most recent big pullback we experienced last year. And what we looked for was how often the market pulled back at least 5% during each rally. And I'll call these material pullbacks. Well, there were 5 material pullbacks in both the post-global financial crisis and post-pandemic cycles. And there have been 2 in the current cycle. So the first observation is that material pullbacks are normal. We also looked at the size of the pullbacks. And as you can see on the graph, the average material pullback was about 7 or 8%. And perhaps our most important observation from our analysis was that when you bought these dips, you then made upwards of 20%. So the point is that when we have a material pullback, and we will, I can almost guarantee you that, unless there is a material change in the economic conditions, it is likely a dip that should be bought. So with that, Jim, let's take some questions.
Great, Jim. Thank you. Yeah, we have a question here in the queue. Let me pull it up. What is the max you would allocate to technology, specifically AI? And how do you adjust the risk of the portfolio to compensate for adding more risky assets like technology?
Yeah, good question. So we have about a quarter of the portfolio in our moderate version invested in technology stocks, and it may actually be approaching more 30% if you include some of our international positions. But the point is that we looked at First of all, when we underwrite a stock, regardless of whether it's a technology or not, we're looking at the expected upside versus the expected downside to assess, how lopsided is the opportunity here. And what we like are opportunities where it's really lopsided, right? Where the market is missing something. And so that's the first thing that we do to try to sort of mitigate risk, is basically tilt the table in our favor. The second thing that we do is we'll look to see what kind of beta we're adding to what kind of beta does this stock have? Is this a very volatile stock? And what we tend to do is we size the more volatile stocks smaller, and that helps mitigate some of that. And then the other way you can do it is basically barbelling in the portfolio. So as I mentioned earlier, we have sort of a abnormally high allocation to fixed income, although a lot of that is in mortgage REITs, which we're really excited about. But what you can do is you can balance the portfolio with some bonds to take some of that risk out. And we've done some of that as well. So, the point is that it is not the right thing as a fiduciary to just go all in and, and take extraordinary risks. What we are trying to do is balance that risk out across the portfolio on a number of different metrics.
Great. Thanks, Jim. I got one other question here. Can inflation, although continuing to come down, keep prices high? In other words, it doesn't feel like inflation is running at 2.5%. It feels much higher.
Well, I mean, the practical reality is,
I tend to agree with that, Jim, as I just filled up my gas tank the other day, and I think it was like premium was like $4.50 a gallon. I felt the thing of that a little bit still.
well, I guess, I mean, some of that may be where you live and what you experience and that sort of thing. The reality is what's happened is that absolute prices have stepped up dramatically. And so, yeah, if we're comparing, like what I'll often do is I'll look at a menu at a restaurant and I'm like, well, when did this dish become $35? I recall it was like 25 a couple of years ago. And if we think about where we sit today in terms of the prices vis-a-vis 2019, you're absolutely right. There's been a massive step up, and it feels like there's no relief. And you're right, there is no relief, except for the fact that inflation is decelerating dramatically. And you can see it in energy prices. You can now see it in rents. You can see it in in food prices. Those have come down a lot. But it doesn't feel that way because we're not seeing everything on sale. And so, yeah, I mean, inflation is real. It's here. I think the question that we're sort of thinking about more and more today is, do some of these big price hikes that occurred over the last couple of years need to get rolled back? Are we going to start to see that, no, you can't charge $35 for that entree. Nobody will buy it. And that sort of thing. So, I think it's just a little bit, to some extent, we sort of have to learn to live with it. But we are watching closely to see if maybe we'll get some relief, but there isn't really any right now. But what I will say is that from a psychological standpoint, the fact that we aren't, I mean, a year ago, we had 10% CPI, right? Which is just wild that prices are going up 10% year over year. That you felt, right? You really feel it when gasoline prices go up. But I think over time, what's going to happen is people will adjust budgets. They're getting paid more. Wage growth is up, and they'll adjust to to this new price level, or the prices will have to adjust one way or the other.
And one final question here, Jim. Do you have nuclear energy in your theme of greater carbon neutral energy need?
So we have done a lot of work on nuclear, and I would have to say that we like it a lot, but we don't necessarily see a path to get paid on that thesis. It is, rational people would basically step back and say, you have to have some level, like nuclear is the cleanest technology out there for generating electricity. Why isn't it like, 50% of the baseload capacity? And then you can add renewable, but you're going to have this reliable, clean nuclear power. It seems to make all the sense in the world, except there just doesn't seem to be a movement afoot to really generate it. more nuclear. You know, it runs into the same old problems of, you know, not in my backyard, right? Where are you going to stick it? And you know, so I completely agree with the idea that we would love to own you know, nuclear and get that sort of exposure. I mean, we do get it in some ways in some portfolios, depending on the clean energy ETF that we own. But in terms of making an actual position on a single name, we just haven't gotten there yet in terms of seeing how that demand for new nukes really materializes.
Great. Thanks, Jim. I think that wraps it up for the questions. And so as we get ready to sign off here, just a couple of things. First, those that are interested, if you haven't done so already, I would highly encourage you to check out Jim's most recent newsletter, where he goes a little deeper into buying the material dips and the work that he did and coming to that conclusion. It's available, as he also mentioned, on our app, Lim Technologies, which can be easily downloaded. We certainly suggest that you do that, as well as all of our content is available on our app. And as always, we remain fully committed to helping you and your clients grow not just their wealth, but your business. And we aspire to try to be as helpful as possible. So if there's anything that you may need, please don't hesitate to reach out to any of us at any time. So with that, thank you again for joining us today. We'll see you next month, and we hope to talk to you before then. Take care. Thank you.
Thank you.